Ever toss around the idea of turning like $100 into, I don't know, a whole bunch more? Like a lot more.
Yeah, who hasn't?
It's tempting, right?
Yeah.
But those get-rich-quick things you see online, not always what they're cracked up to be.
Nope.
So today we're diving into something you sent over a video transcript about beginner investing. And get this, the guy calls himself Mr. Goldman.
Gotta love the confidence.
Right. But cheesy nicknames aside, what caught my eye was how approachable this source is. It's like a friend giving advice, which, honestly, is what we aim for. Okay, so Mr. Goldman, he kicks things off with something that might seem kind of, well, boring. High-interest savings accounts.
Yeah, not exactly glamorous, but hey, solid foundations rarely are, right?
True, true.
So high-yield savings accounts are low risk. The source actually gives them a 1 out of 10, mainly because of the thing called FDIC insurance.
Right, the safety net. I remember when I first learned about that, it was like huge relief knowing your money's protected up to, what is it, $250,000? Even if the bank, well,
Goes
Yeah, exactly. That's peace of mind.
Definitely. And the source makes a good point that sometimes gets lost in all the talk about big returns, the emergency fund.
Oh, yeah.
He's got this story about his water heater break in his first apartment. Talk about bad timing.
Ugh, the worst.
But having that emergency fund meant no scary loans, no credit card debt.
Been there, no thanks.
Exactly. He even mentions a couple places, Marcus by Goldman Sachs and Ally Bank, as decent high-yield options.
Okay.
It's worth doing your homework, though, right? Seeing who's got the best rates, that kind of thing.
Always shop around.
Exactly.
Makes sense. Okay, so from virtual vaults, let's go to something a bit more, I don't know, tangible. Our pal, Mr. Goldman, true to his name, is big on gold, calls it a safe haven.
And gold as a safe haven, that's not just like marketing.
Right.
It's held its value for centuries, right? Often seen as a hedge against inflation. When everything else seems to be getting pricier, gold kind of holds steady.
So if you're worried about your money losing value over time, gold could be a good move.
Could be, but, and this is important, it might not grow as fast as some other things, stocks, real estate, things like that. Opportunity costs, they call it. Basically what you might miss out on by choosing one thing over another.
Gotcha. Now, when we talk about buying gold, are we talking like actual bars of gold stashed under the mattress, asking for research purposes?
Not quite. He suggests using apps like Robinhood to buy into something called a gold ETF.
Hold on, gold ETF. Before we go there, can you break down what an ETF even is?
Sure, yeah. Think of them like baskets of assets, stocks, bonds, even gold all packaged together. And you buy and sell these baskets on the stock market, just like individual stocks.
Okay.
And in this case, this GLD ETF, it tracks the price of gold.
So basically, you're investing in gold without, needing Fort Knox level security.
Pretty much. It's way more accessible.
That is accessible. Gold investing from your couch. Love it. But let's be real. Most people are probably looking for a bit more growth potential than what gold usually gives. Right? And that's where index funds come in.
Bingo. He describes index funds as a way to invest in top companies without needing to be, a stock market guru. And he uses the S&P 500 as an example.
Okay.
Basically, it's like the 500 biggest publicly traded U.S. companies all in one.
So instead of trying to pick individual winners, which, let's face it, is a gamble, you're spreading your bets.
Exactly. You're spreading your risk, which is what diversification's all about. With an index fund, one company doesn't make or break you.
Right, like don't put all your eggs in one basket. Stock market edition.
Exactly. And speaking of not putting all your eggs in one basket, the source mentions Warren Buffett.
Okay, now we're talking.
Buffett, yeah, the big guy. He actually made a $1 million bet that an index fund, specifically the Vanguard S&P 500 index fund, would do better than a bunch of hedge funds over 10 years.
No way. Did he win?
He did, and it wasn't even close. The index fund, like the boring option, totally crushed it.
Wow, that says a lot. Although, while fractional shares, which he says Vanguard and Fidelity offer, make it easier to get started, dropping $100 on an S&P 500 index fund doesn't exactly make you a high roller.
True, but it's a start, right? A solid step towards long-term growth. And speaking of long-term growth, through property, though, he talks about REITs.
REITs. Okay, now you're just speaking another language. Break that down for us.
It's simpler than it sounds. REIT stands for Real Estate Investment Trust. Basically, it's a way to get into real estate without actually owning property.
So you're saying I can be a real estate mogul without dealing with, like, tenant phone calls at 3:20 a.m.? Sign me up.
Pretty much. It's like owning a tiny piece of a skyscraper or a shopping mall, or, as our source puts it, owning a piece of a building, the front door, the windows, whatever. He even mentions trading 212 as a platform for REIT investing.
Interesting. Now, I know some people listening, they like a more hands-on approach to this whole making money thing. So let's talk flipping.
Ugh, the buy low, sell high game. Definitely more hands-on than, say, a savings account. The source, he gives it a 4 out of 10 on the risk scale. And as he says, it can be pretty profitable if you know your stuff.
4 out of 10. Yeah, that seems about right. A nice balance between potential reward and, well, you got to have some knowledge to actually pull it off.
100%. Spotting those diamonds in the rough, knowing what they're worth, finding the right buyer, that's the key.
It's like those antique shows, right? Where they find some hidden gem at a flea market and retire early.
Well, he actually uses an example kind of like that. Talks about flipping a model engine he found for about $100, selling it for a profit on eBay or a specialized website.
See, hidden gems are everywhere. Okay, but seriously, any pitfalls people should watch out for?
Good question. The source mentions market saturation, too many people selling the same thing, competition from, the pros, and the need for niche knowledge. It's not always as easy as those house flipping shows make it seem.
Right, not everyone's cut to be on HGTV. Okay, so we've gone from super safe savings accounts to the thrill of the, makes explosion sound, flip. But now for the grand finale, let's talk individual stocks.
This is where it gets really interesting, and where understanding risk is super important. He gives individual stocks a 6.5 out of 10 on the risk scale.
Okay, that's a jump from the safety of a savings account. What makes them so risky?
Well, unlike with index funds where you're spread out, with individual stocks, you're betting on one company.
All your eggs, one very fragile basket.
Exactly. If the company does great, your investment could skyrocket. But if they tank or the whole market takes a dive, you could lose big.
And let's be real, predicting the stock market is basically impossible. Even the experts get it wrong all the time.
All the time. It's so complex, so many factors at play. It's as much about psychology, about how much risk you can handle, as it is about crunching numbers.
So how does our guy, Mr. Goldman, handle this whole individual stock thing? Does he have some secret formula?
Well, he does something kind of wild in the video, gotta be honest. He throws a dart, like literally at a board with 20 company names on it.
You're kidding me. That's his strategy, leaving it all up to chance. Well, which company did the dart of destiny land on?
Drumroll sound in background, Sam Pagan.
Samsung. Not a bad pick. They seem to be everywhere these days. Phones, appliances, everything. It's a household name for sure.
Right. And he makes a point of mentioning that Wibble, that online brokerage, they're giving out 3 free stocks when you put in $100.
Free stocks. I could see why that'd be tempting, especially for new investors.
Totally. But, and this is important, always read the fine print.
Oh, absolutely. Got to make sure you understand the terms and conditions, any fees they might sneak in there.
Exactly.
Okay, so we've covered some serious ground today. Everything from those safe and steady savings accounts to the wild world of flipping, and then the, let's call it exciting, world of individual stocks.
It's been a wild ride for sure, looking at all these different ways to grow that money.
And I think the big takeaway here is that there's no one right answer, no magic formula for everyone.
Definitely not. It's all about finding what's right for you, what you want to achieve, how much risk you can stomach, all that.
If I had to sum up today's deep dive, I think it would be informed investing, right? Don't just follow the crowd or believe those promises that seem too good to be true.
Couldn't agree more. Take the time to actually understand what you're getting into, the good and the bad, the potential rewards, and the risks that come with any investment. That's how you make your money work for you, not the other way around.
Couldn't have said it better myself. And hey, who knows? Maybe that $100 really can become something amazing.
Anything's possible, right?
Yeah.
It all starts with taking that first step.
And on that note, we always like to leave you with something to think about. So after hearing all of this, from the super safe to the more speculative, which one piqued your interest the most and why? Maybe it's something you're ready to try out, or maybe it's just a starting point for some more research. Whatever it is, we'd love to hear your thoughts. Until next time, happy investing.